Good afternoon, everybody. My name is Chris Head. I'm the private sector specialist with the Climate Investment Funds. We're an $8.3 billion climate finance trust fund housed here at the World Bank. We work in 72 developing countries to drive climate-smart investments in renewable energy, energy efficiency, climate resilience, and forestry. So a few weeks ago, thousands gathered in Marrakesh for the UN Climate Summit. This was a follow-up to the historic Paris talks of the year before. And one of the biggest takeaways was the need to crowd in the private sector in climate-smart investments. But why is the private sector needed for reaching the goals set under Paris? Why not just rely on public and government funds? The short answer is, there isn't simply enough public funding to meet the scale of the climate challenge. We really need trillions of dollars, and not just billions, to plug the gap. In 2014, there was approximately $62 billion in public funds going to support climate investments in developing countries. But research shows that we need around $50 trillion in sustainable infrastructure in those markets by 2030. And the clock's ticking. So scaling up private sector clean energy technologies like solar and wind and CSP, geothermal, all of that will be critical to meeting the goals of the Paris Agreement. And these technologies deserve a lot of attention. But something else that deserves a lot of attention and additional funding is climate resilience and adaptation. So why is this important? Simple. Climate change poses a significant business risk in many markets. Climate shocks, such as prolonged droughts and intense floods, can destroy crops and equipment and other goods that the private sector relies on to generate income. And many climate events can set back entire economies and have effects that reverberate around the globe, such as increased conflict and migration. But businesses that are resilient to the effects of climate change can be better equipped to withstand damaging weather events, and they can bounce back faster. But this doesn't come cheap. The annual adaptation costs in developing countries is expected to be between $150 and $300 billion a year by 2030. That's much higher than the $25 billion that was made available to these countries last year from public funds. So the questions are, how can we help businesses make their assets and operations more resilient to the expected effects of climate change? And how can small amounts of public funds help catalyze the early pioneering investments so that the sectors most vulnerable to climate change, such as infrastructure and agriculture, can eventually do this on their own? So how do we make this a best practice? To figure this out, I think we need to talk about risk, both assessing risk and addressing risk. So let's start with assessing risk, and let's talk about mindset. And here's what I mean. Unlike investing in, say, a wind farm, making a business more climate resilient does not usually generate income. But what it can do is reduce losses, in addition to increasing operational efficiencies. So the bottom line is, climate resilience is an issue of assessing risk. Are you as a business owner susceptible to a changing climate? How? And what does that look like? So first, we need to communicate to companies across all sectors in developing markets that climate change may pose a risk to their future operations and revenue streams. And we need to help them figure out how to assess that. So let me explain how I've seen that work in practice. So Nepal is a country that's highly vulnerable to climate change. It also has some pretty good hydropower resources. Harnessing water responsibly can get electricity to millions of people. And that's especially true in South Asia, where lack of access to power is acute. But climate change events such as increased glacial melt, more intense floods, increased runoff, that can all damage turbines and other hydro infrastructure. And these events can make a hydropower plant repeatedly go down for maintenance, reducing revenues for the company and increasing their costs down the line. And it can reduce the amount of clean power available in a country that very much needs it. So the climate investment funds, alongside IFC, are working with hydropower developers to do climate risk assessments. These look at how climate change is expected to affect a specific hydropower plant in a specific location. This information can then be presented to decision makers, along with the cost to make the asset more climate resilient, such as better turbines and increased water control technologies. This helps a company make an informed decision on the costs and the benefits of climate action in their own business. So that's step one. That's assessing the risk. So step two is, how do we address that risk? And specifically, how providing concessional financing can help address climate risk. So the main idea is, from a risk mitigation standpoint, a relatively small investment now to make operations more climate resilient can save a large amount of money down the road. And if a lot of companies and SMEs that make up entire sectors are better prepared for climate change events, then this can make entire economies more climate resilient. But implementing these measures can be risky. There's a few reasons for this, such as A, there's often a lack of capacity to implement these measures for many businesses, especially those in least developed countries. And B, most years, these measures may not increase revenue or reduce costs at all, because there's a chance that a climate shock doesn't occur in that time period. So in other words, if you're running an SME or a large agribusiness company, why spend the extra money on climate adaptation measures? There are a lot of things to invest in that can help grow your business here and now. And spending limited money to protect against a future weather event that may or may not happen probably isn't high on the list. So how do we help move it up the list? By providing long-term, low-cost concessional financing, we can help early adopters pay for these investments and address these risks. For example, in the Sertão region of Brazil, in the last 50 years, temperatures have gone up by an average of about 2 degrees Celsius. At the same time, rainfall has gone down by about a third. So many farmers are responding to this by shifting from growing crops to clearing more land for their animal herds, which of course can lead to deforestation, more soil erosion, and harming the local water resources, all of which can lead to a vicious cycle of environmental degradation and poverty. So the Inter-American Development Bank is working with farmers to overcome this challenge. They're using a method called the Climate Smart and Sustainable Agricultural Production System. It sounds technical, but essentially it's looking at how technologies and processes, such as efficient farming equipment or drip irrigation technologies, can help farmers better adapt to a changing climate without harming the environment. To address the risk in investing in new areas like this, IDB is working with a local bank. Because of their expertise, IDB can help them get up to speed on the market and show them that lending to their SME clients for climate resilient technologies can be a profitable and sustainable line of business. These loans can be made possible through a credit line to the farmers on concessional terms and can be critical to building the business case of those farmers and SMEs that these technologies can make economic sense and eventually can be a best operating practice. And the project has already led to some solid outcomes. About 30% of the vegetable farmers in the program have seen net income gains of about 30%, with about the same numbers showing very substantial improvements in quality of life. So overall, climate resilience investments are not the world's sexiest topic. They're not the best dinner party conversation. It lacks a little bit of the excitement of renewable energy projects. But it matters, because making the business case for companies to take a closer look at their exposure to climate risk will help us all in the long term. And addressing risk through providing concessional financing will help sectors throughout developing economies in the short to midterm. So in conclusion, as they say across the pond, an ounce of prevention is better than a pound of cure. By assessing and addressing climate risk, businesses can deliver a triple win of being good for their company, good for citizens, and good for the planet. Thank you.
you can have a seat. What is the uptake of including climate risk within the private sector? I mean, it sounds like it's still at quite an early stage right now, but what's the hope and what's the response from the private sector?
Yeah, I think we've seen different things in different markets. I think in more developed economies, you're seeing a little bit more kind of recognition of the threat, a little bit better risk assessments, looking in the long term. I think one of the main challenges is these least developed economies that we work in. And there's a lot of other things to consider when you have a farm, you're an SME, you're running a business. And so thinking about this risk kind of in the mid to long term can be tough. And I think that first is kind of wrapping your head around it, and second is kind of, what are we going to do about it? So I think we're seeing limited uptake right now, but I think that a lot of MDBs are putting more focus on this, and I think that that's going to really start affecting some of the projects pretty soon.
Yeah, because we've heard a lot that if you put $1 investment into building resilience, you often get a return of about $4.
Exactly.
Which would have been the cost that you'd have to pay because of the impacts of a climate stress or shock.
Yeah.
So I'd like to open it up for questions. We've got some mics here at the front. We should probably take them out. Do we have any questions from the audience?
Hi, my name's Tom. Thank you for that. I'm wondering, this is probably happening more quickly in the developed world, but have you seen any movement in the private sector to actually use carbon pricing mechanisms to take in these risks, actually internalize these risks?
It's a good question. We haven't seen that as much at this point in the developing countries that we're looking at. I think it's a possibility, but I think right now it's really kind of more of a next step.
But in the governments that you're working with, it's quite well accepted that one has to internalize climate risks, or what's the perception at the moment?
It really depends government by government, but I think that it's still a pretty new thing, right? And I think that when you look across these sectors, whether it's public or private sector that's doing this, there's been a certain way to do projects, like build a hydropower dam for decades. And so, and risk has been assessed in a certain way, like when you do those projects. And I think that now with this new risk that's coming up, I think that it's only recently, probably last few years, when some governments have even started hearing about this. And I think that there's still a lot of uptake left to be done. No.
And you think that's also aligned with the increased realization that their climate impacts are costing the countries? I think over the last 10 years, we've seen more frequent climate stresses and impacts that are costing economies billions. So there might be a correlation there.
Definitely. And I think that it's just going to be an issue that is looked at more and more moving forward. And I think finding out how to assess this, how to finance this, what mechanisms you use is going to need some more attention moving forward.
Absolutely. Do we have another question in the audience? We've got one at the very back. There's a mic coming to you in a second.
Hello. What then is the place of the insurance companies in transferring some of those risks? Because we cannot avoid, we might have to transfer some of the risks. So what is the place of the insurance companies in those kinds of projects? Projects which might have to talk in or factor in climate as a risk. What is the place of insurance companies in assessing those risks?
Yeah. I think climate insurance is going to also have a pretty big kind of movement moving forward. I think insurance is kind of, once the event happens and you can do payouts to those that are subscribed. This is kind of the flip side of the coin, which is trying to prevent the negative effects to happen in a business, in an asset. But I think climate risk insurance is definitely a different side of the equation, to where what do we do beforehand, and then once an event happens, then all right, how do we pay out? How do we make this right?